Good afternoon, ladies and gentlemen. Welcome back to the last weekly market review for the month of April, 29th of April. As usual, today I have with me Mr. Gerald Wong. How are you, Gerald?
Hi everybody. I'm good. So I think very quickly we are into the end of the fourth month of 2024 already. Market continues to be volatile, so hope to be able to share some of the updates with the viewers today.
Yes, 4 months passed so fast, so quickly, right? Into the fourth month of this year already. And last week we saw a rebound in the capital markets as well as some of the big tech earnings which came in positively, hence market, especially the Nasdaq index having a rebound. We also have some of the Singapore corporate earnings results coming in also last week and this week. So will you be bringing us through some of the results?
Yes, so that is what I'll be sharing today. Quite a number of REITs that reported last week. I will provide an update on these REITs. Before we start, just a bit of a disclaimer that today's sharing is for information purposes only and should not be taken to be financial advice. If you find the weekly market review helpful, do scan the QR code to leave us a review on Google. And if you would like to join different events that SIAS is organizing, do consider joining SIAS as a member, which costs only $12 per year or $1 per month. Okay, so as Sunny shared earlier, we saw a rebound in the market last week. I would call it a relief rally, where due to the easing of the geopolitical tensions in the Middle East, we saw global stock indices rebounding. The S&P 500 was up by 2.7%. And as we can see here, the gains were led by the tech stocks, with the Nasdaq up by 4.2%. Okay, this was also assisted by the strong earnings reported by selected tech companies, where we saw companies such as Google, Microsoft actually having a share price bounce after the strong results. Okay, closer to home, the improved sentiment also helped to boost the STI, which was up by 3.2%. Okay, so this is what we saw. If you recall the weekly market review in the previous week, we were saying that because of rising uncertainty in the market, because of interest rate changes, because of the geopolitical tensions, the market has become more volatile as measured by the VIX. But as we saw this week, the VIX has started to come down, and that has also helped to boost the sentiment towards the stock market. Okay, one thing to take note of is that while we are having that positive momentum in the stock market, I'll still continue to keep a close lookout for the rise in the US government bond yields. So that is an upward trend that we continue seeing in the past week. Okay, so reaching the 4.7% level last week, and has been on a steady upward climb since the start of this year. Okay, and something to keep a very close lookout for would be the upcoming Fed meeting on the 1st of May. What we see here is that the general expectation is for the Fed to keep interest rates unchanged in the meeting. So close to 100% probability that they will keep the interest rate unchanged. But what we do notice here is that the expectation of the pace of rate cuts is actually slowing down, such that at the end of this year, we might only be looking at one rate cut in 2024, with the rate cut coming through in September this year. Okay, so I mentioned earlier that the STI saw improved momentum, and this is led by a number of stocks that saw significant gains in the past week. We've got Seatrium that was up by 15.6%. A number of the Jardine-related names also did well at the back of bargain hunting. So Hong Kong Land up by 11%, DFI Retail Group up by 9%. Okay, the developers also started to rebound slightly, with CapitaLand Investment up by 7.3%, City Developments up by 5.7%. Okay, in terms of worst performance, the good news is that there were not a lot of decliners in the past week. In fact, the one that had the share price down was DBS because it was ex-bonus shares. So effectively, the stock is still up after adjusting for the bonus issue. Okay. So generally, we do see this improved sentiment in the market as the concerns around the Middle East tensions actually start to ease, and that is reflected in the Singapore market as well. Okay, so we also had quite a number of REITs reporting their results in the past week. So I'll go through a few of them that we commonly get questions about. I'll start with CapitaLand Ascendas REIT, since this is a name that a lot of investors in Singapore follow. We see that the share price has been fairly resilient in 2023, but in 2024, having some signs of weakness from above $3 per share, now down to $2.60 per share. Okay, so just as a quick recap on CapitaLand Ascendas REIT portfolio, the bulk of its assets are in Singapore. You have got 64% of the assets in Singapore, and then about 10% each in US, Australia, as well as in UK, Europe. In terms of the split of the assets, about 45% will come through from what they would call relatively new segments, such as business space and life sciences, about 26% from logistics, and then 29% from industrial and data centers. Okay, so in terms of what CapitaLand Ascendas REIT reported, first, the occupancy rate actually came down compared to the previous quarter. This was what we saw across its portfolio. Singapore occupancy was down about 0.4% compared to the previous quarter. And likewise, we saw varying degrees of decline in the occupancy rate in the US, Australia, and in UK, Europe. So that brought the overall portfolio occupancy down to about 93.3% as of March 2024, from 94.2% in December 2023. Okay, so that represents about a 0.9% decline compared to the previous quarter. The more positive news is that the rental reversions were fairly positive, and in fact, they accelerated in the first quarter. Okay, so this is especially the case in the US, where we saw a 28% increase in the rent reversions versus 11% in the fourth quarter of last year. So even though the rental reversions in Singapore came down slightly, overall, we saw the total portfolio reversions actually increasing to 16.9%. Okay, so that is the bright spot in CapitaLand Ascendas REIT business update. Okay, if you were to look at the balance sheet, not much changes here. The gearing remains below 40% at 38.3%. And in terms of the total amount of debt that they have fixed, it is at 82.6%. So that might help to address some concerns about how it may be impacted if interest rates rise further from here. Okay, the other good news about CapitaLand Ascendas REIT is that it is actively taking steps to be able to manage its portfolio. So quite a number of asset redevelopments and asset enhancement initiatives that we see here, with an estimated total cost of 551 million. This will be staggered and will be progressively completed through the first quarter of 2026. So as some of this come through, the expectation is that they may help to subsequently boost the net property income of CapitaLand Ascendas REIT. So at this point in time, what we see for CapitaLand Ascendas REIT is that with the fall in its share price recently, you've got a dividend yield of about 5.8%, just below the historical dividend yield of 6.1%. Okay, so that was CapitaLand Ascendas REIT, and whenever I mention about CapitaLand Ascendas REIT, a lot of people will also ask me about MapleTree Industrial Trust. So this is the chart that we see for MapleTree Industrial Trust. Quite a similar trend to what we saw for CapitaLand Ascendas REIT, where it did well in 2023, but then having some correction in 2024. Even though what we see here is that MapleTree Industrial Trust has been a bit more resilient compared to CapitaLand Ascendas REIT. Okay, so this is what we saw in terms of what it reported for the fourth quarter of its fiscal year 2324, which is also the quarter ending March 2024. Okay, so gross revenue increased in the fourth quarter of the fiscal year, and likewise the net property income grew by 2.2%. Okay, so while there was a slight increase in the number of units in issue, overall, they were still able to raise their distribution per unit by about 0.9% to 3.36 cents. Okay, so what we see here in terms of the occupancy rate for MapleTree Industrial Trust is a similar trend that we saw for CapitaLand Ascendas REIT, where there's a decline in the occupancy rate across the portfolio. So for MapleTree Industrial Trust coming down from 92.6% in the third quarter of fiscal year 2324 to 91.4% in the latest quarter. Okay, so earlier we saw the dividend yield of CapitaLand Ascendas REIT at about 5.8%. This is what we see for MapleTree Industrial Trust as well, at 5.7%. But for MapleTree Industrial Trust, given that the share price has been a bit more resilient, the dividend yield is still below the historical average of 6%. Okay, last but not least, I wanted to share a bit more about MapleTree Pan Asia Commercial Trust. So unlike CapitaLand Ascendas REIT and MapleTree Industrial Trust, we have seen more weakness in the share price of MapleTree Pan Asia Commercial Trust, recently touching close to a one-year low, and then rebounding slightly into the later part of last week. Okay, so some of you might be wondering, how is the performance of the REIT and whether the share price decline is actually justified. Okay, so first and foremost, we do a quick recap around the breakdown of its assets. And what we see here is that in terms of the contribution to the net property income, Singapore continues to represent the largest contributor at about 60% of the net property income. Hong Kong is about 21%, China is 10%, and then you've got Japan at 8% and Korea at 1%. Okay, so Singapore is the bulk of its assets, but because of its exposure to Hong Kong and China, that might have impacted sentiment towards the REIT. Okay, so what we saw in terms of the latest results is that the gross revenue actually increased compared to the previous year. And likewise, the net property income was an increase compared to the previous year by 3.2%. Okay, the good news is that they managed to increase their distribution per unit in the fourth quarter of fiscal year 2324, which is once again the quarter ending March 2024. Okay, so the 2.29 cents of distribution per unit would be a 1.8% increase compared to the previous year. Okay, so if I were to look at the occupancy rate of MapleTree Pan Asia Commercial Trust portfolio, the crown jewel continues to be VivoCity at 100% occupancy. So doing very well if you are a frequent visitor to the mall. But what we do see for some of the other properties, particularly the office property, is that there has been a decline in the occupancy rate. For MBC in Singapore, as an example, declining slightly to 96% from 97% as of 31st December 2023. Okay, the retail asset in Hong Kong continues to do fairly well, close to 100% occupancy. And then at China, the occupancy remains below 90% at 87.5%. So putting all of this together, a slight decline in the occupancy rate to 96.1% compared to 96.7% in the previous quarter. Okay, if you were to look at the rental reversions mixed picture, so the Singapore assets do fairly well in terms of the rental reversions, particularly for VivoCity. Okay, so 14% rental reversions, while for the office asset, MBC slightly lower at 6.7%. Okay, it is really in the overseas assets, particularly in Hong Kong and China, where we are still seeing negative rental reversions of 8.7% in Hong Kong and 2.7% in China. So given the strong performance in Singapore, and if you recall earlier, that represents about 60% of the net property income. So MapleTree Pan Asia Commercial Trust is still able to generate a positive rental reversion of 2.9% across its portfolio. Okay, if we were to look at its balance sheet, the leverage ratio came down slightly to 40.5%. And in terms of the amount of debt that has been fixed that has been put at a fixed rate, it was at 77%, down from 85% in the previous quarter. What we also see here is that the weighted average all-in cost of debt seems to have stabilized a bit at about 3.35% in the latest quarter versus 3.33% in the previous quarter. So that might also have helped to explain the ability for it to grow its distributions in the latest quarter, as what we see is that the interest expense is not increasing sharply further. Okay, so the dividend yield for MapleTree Pan Asia Commercial Trust now at about 7%. And as we can see here, this is above the historical average. And likewise, if you're to look at the valuation of MapleTree Pan Asia Commercial Trust, given that it is trading at a one-year low, the price to book at about 0.7 times, which is below the historical average of 0.9 times. Okay, so I have shared quite a number of the REIT results, particularly the ones that we commonly get asked on. This week, we have a short trading week because of the public holiday on Wednesday. But for those who are actually watching the market closely, do remember that we have the Fed meeting that's coming up on the 1st of May as well. Apart from that, quite a number of us should be looking at the DBS earnings after they went ex-bonus issue, and likewise the Apple earnings that is on Thursday, 2nd of May. Okay, on the macroeconomic data front, we'll be looking at the US jobs data that's coming up on Friday. So quite a number of things to look out for, even though it is a short trading week in Singapore. So with that, I'll hand over to Sunny, who will share with us the latest technical analysis. Sunny, over to you.
Okay, thanks Gerald for that reminder that we have a public holiday this week, 1st of May, Labor Day holiday, much needed holiday for everyone, I believe. But then again, market still has a lot of things that's happening, especially the non-farm payroll labor data that's coming up on Friday. So let me do a recap of the Singapore Straits Times Index first. Last Monday on the 22nd of April, we are over here, this big green candle over here. You can see that last week was a good week for the STI index. First thing first, because of the relief of the tension from the Middle East, caused the market to rebound, because that has caused a bit of concern in the market in the previous week, and hence there was a bit of pullback. But once the tension cooled down, you can see that most of the global markets, including Singapore, had a rebound upwards. So Singapore is no surprise over there. And then we targeted the year-to-date high of about 3262. That is the high that we observed somewhere on the 27th of March, where it's the year-to-date high. We say that that would be the resistance level for the STI index. And the following day, on Tuesday, 23rd April, we hit and breached that level of 3262. And then we had a new year-to-date high over here. So this was the blue arrow that I indicated earlier. So the new year-to-date high would be on the 24th of April, Wednesday, and we hit a high of about 3,308 points level. So this is the new year-to-date high to look out for, the new level that we should be focusing on. Okay, so we also breached the upper bound of the Bollinger Band. Hence, you can see that the last 3 trading sessions, including today, we had a red candle, which is a pullback. So that is not a surprise, because the market is going through a very strong recovery and there's some kind of a mean reversion or a pullback right now. So when we say a mean reversion, we are looking at it to be pulling back towards the 20 days moving average, which is also the basis of the Bollinger Band. And that is around the 3230 or the 3226 level. So 3230 is now the 20 days moving average level, which would likely be the first support in a very strong uptrending market. The 20 days moving average will usually be a strong support level to get back in on the counter or the index that you're looking at. So anything below the 20 days moving average, it is also time to accumulate again. So I'll just put in, as usual, the highlighted price range level that we are looking at. So the next support level, of course, 20 days moving average over here. Anything below that and towards the, let me just turn off this first. Okay, so anything below the 20 days moving average, 3230, towards the 50 days moving average. So this zone around here would be an area that I would start to pay attention and look for possible chances to accumulate when the STI pullbacks towards this level. So looking at the indicators of the STI index, you can also see that the MACD indicator today on the 29th of April is also starting to show signs that the uptrend that we observed the last week has been subsiding already. We have seen that the MACD starts to converge towards the signal line. The first sign of it happens today. So that could be an indication that a pullback in the short term is likely going to happen. But then the support definitely comes in on the MACD 0 baseline also. So, but we are still some gap. We still have some gap away from that point of reading. So definitely the pullback would likely happen towards the 20 days moving average before we see any further indication of the MACD indicator. The RSI now is reading at 59.9. It has come down from a high of about 64.7 on the Wednesday of last week. So we are going in a downwards direction towards the 14 days RSI moving average of 53.8 and also going towards the 50-point neutral mark. So that means that momentum is getting weaker and weaker in the past 3 trading sessions. And this trend is likely going to continue again, looking at the trajectory. So again, looking at the 50-point baseline in the RSI indicator to see what happens next. If it's going to support or is it going to breach the 50-point baseline. If it goes below 50, then the negative momentum is going to build up further, and then we have a further pullback. So this STI having gone through a very good performance last week, this week it's not surprised to see a pullback or a mean reversion. And do take note, if a pullback happens too much, then definitely the opportunity comes back again for us to accumulate on the STI index. But so far so good on the STI index. We are still on the higher side since we opened the start of the year. Okay, so next, let me move to the US indices. So we also have a very good week on the US index also. Dow Jones index, you can see we have seen the first green candle on Friday compared to the previous 2 sessions on Wednesday and Thursday, where we have some red candles over here. So you can see that we are resting very nicely on the amber line, which is the 100 days exponential moving average that you see over here around the 37,900 level. So 38,000 level for the Dow Jones index now seems like a very strong and comfortable support level for the Dow Jones index. You can also see from the indicators that we also see a first positive sign of the MACD reading for quite a bit of time, for about 3 or 4 weeks already. This is the first positive MACD reading that we see on the Dow Jones index in that period of time. So it could be a sign that the uptrend that we see since the beginning of the year or since the end of October last year may likely going to be continuing the rebound upwards again. Okay, so but we need to look at this, how the strength of this rebound, how strong is it going to be? Looking at the trajectory of the MACD line against the signal line, you can see that there is not much of a gap or divergence, I would say. So that means that the momentum of the rebound is not going to be as strong as what we observed previously. So what do we mean by that? If you look at the October rebound, right, you can see that the gap between the MACD line and the signal line is actually pretty wide. So that means that there's a lot of momentum inside that rally, and that rally is likely going to continue further. But if you fast forward to what we see right now, the gap is not really that prominent yet. So we need to wait for a few more data points, a few more trading sessions for that to develop, to see whether that momentum will start to grow, and then the investors will have more confidence in loading up on the Dow Jones index. Looking at the RSI, the latest reading last Friday is at 45 points, slightly above, 5 points above the 14 days RSI moving average reading at 39.7. We are also 5 points away from the 50-point neutral mark. If we breach that 50-point neutral mark, that will be another indication that momentum is building up on the Dow Jones Index again. So for now, with both the MACD indicator and the RSI not showing any signs of a confirmation of a momentum building up yet, I will still use the 100-day moving average as a good support level if I'm looking at accumulating in the Dow Jones Index that is at the 37,900 points level. Okay, next let's move to the broad index S&P 500, who also had a very good 1 week performance for the past 1 week. This is now breaching or touching the 20-day moving average or the basis of the Bollinger Band right now. So we have we got close to the 100 days moving average, but did not really tested that, and then we had that rebound upwards already. If you look at the indicators of the S&P 500, you can see that at least for the past 5 trading sessions, that uptrend moment or that negative momentum that we saw in the past 1 month has been subsiding greatly and tremendously. And now the convergence of the MACD line towards the signal line is getting so close that a crossover would likely happen. And when a crossover of the MACD line above the signal line below the zero baseline happens, it's likely going to signal a very strong rebound that's going to come. So I'm looking forward for that confirmation to come where the MACD line cross above the signal line. That will be the first indication that we are going to have a change in direction of what we see in the past 1 month. And if let's say both of the lines cross above the zero baseline of the MACD indicator, then the uptrend is likely going to be more sustainable, and then we may challenge the year-to-date high again that we observe. Let me put in the year-to-date high line over here, which is somewhere in April period. This is the 5,263 points level. That is the year-to-date high that we have so far on the S&P 500, which is about 160 points away from last Friday closing of 5,099 points. Okay, so do look out for the S&P 500 gaining that confirmation from the indicators, and then the rebound to retest the year-to-date high, especially with some of the earnings that continues to come in strongly from the earnings seasons. Some of the report that I have read so far, about 45% of the companies have already reported these earnings seasons, and 4 out of 5 of the companies actually beat the market expectations in their earnings results. So that means that this seasons of earnings result is still likely going to be very strong quarter for the US indices. Next, let's move to the Nasdaq Composite Index. So Nasdaq Composite Index, of course, was the best performer amongst the 3 US indices last week because the big tech counters, Microsoft and Google, actually came in with very good results that pushed the tech sector much higher. And the Nasdaq Composite Index, being a tech-heavy index, of course, did not disappoint. We are now testing the 20 days moving average again. We use that 100 days moving average as a pivot, and now we are testing that 20 days moving average on the charts itself right now. So we are still on the lower bound of the Bollinger Band, as you can see. But once it breached above the 20 days moving average, if you zoom in closer, you may see a change of direction in the 20 days moving average trajectory again. And that could mean that would be a resumption of the uptrend for the Nasdaq Composite Index going forward. The indicators are looking very similar to the S&P 500. MACD line converging towards the signal line at a very close angle right now. And a breach of above the signal line would mean that a confirmation of the uptrend that we are likely going to see with the crossing of the zero baseline would mean that the increase in momentum upwards that we will see. So I'm going to put in the year-to-date high as well. Is something that we saw on 21st March that is around the level of 16,500 and 16,538 points. So that is the level that we are going to target first if, let's say, this rebound upward is going to happen. So the level now is at 15,927 points. So we probably have a very nice 500 points upside for the Nasdaq Composite Index if the rebound is going to continue. On the RSI, it's looking a bit more promising than the MACD indicator. The RSI has already been touching and slightly breached the 50-point neutral mark already. The last Friday reading at 50.17. It's also quite a significant gap away from the 14 days RSI moving average at 43. So it's likely going to see a breach of above 50-point reading this week on the Nasdaq Composite Index with Amazon and Apple's earnings coming up, and that could also push the MACD line above the signal line, and that would mean a confirmation of the resumption of the uptrend of the Nasdaq Composite Index to retest the year-to-date high at 16,538 points. So looking good right now on most of the major indices. The key thing that I'm looking at right now is inflation data. Of course, last Friday, we have the PCE price index coming in as well. So it's still slightly high. And that would mean that I am foreseeing that the Fed might come in with some hawkish comments following the interest rate decision this Wednesday. So that could cause some pullback in the markets, but if the earnings, the economic data and the earnings continue to power the US economy forward, so that's not much of a concern. If let's say some of the hawkish data were to make some pullbacks in the market, that would means an opportunity for us to accumulate on those pullbacks. Okay, so that's all I have for this week's sharing. Anything to add, Gerald?
So quite a number of things to continue to keep a lookout for. In Singapore, we still have the result season that is going on. We have the Fed meeting that's coming up this week. We also have the macroeconomic data from the jobs data as well. So do keep a lookout for these events as we continue to navigate the market environment.
Yes, yet another busy week. And over here, I think we just want to wish everyone a happy Labor Day, a happy shorter trading week, so that everyone can have some rest also while catching up on the markets, okay? So I think that's all the time that we have for today. In the meantime, do stay safe and trade safe, and we'll see you again next week in the next weekly market review. Goodbye.
See you.